Great. So many lawyers and compliance people and risk people, going to be a great panel. That is the necessary ingredients. So my first question is for Aga and Julian. Why Singapore? Why are so many virtual asset service providers coming here and applying for a license? Aga, why don't you start?
I think the framework here in Singapore has been quite attractive for a lot of players. And if I use Australia as a guideline, there's not the regulations there, but there's a lot of players there that want to pay in a regulated environment. And I think they see Singapore as attractive to become compliant, to show their customers in Australia and around the world that they want to choose to actually get regulated in a better playing environment such as Singapore. Then the government has been very proactive with it, and obviously to set up business is quite easy to do as well.
Fantastic. Julian, what can you add here?
Sure. I mean, I could maybe just add a point to Aga's point. I think regulatory certainty is actually good. And if we think about the recent, bull run in Bitcoin and other digital assets, I think it's at least in part has to do with the fact that regulatory certainty around the world is making it easier for institutional players to actually participate in this space. I think the other thing, is generally speaking, Singapore is already a traditional financial services hub. And for many of the same reasons, VASPs are looking to Singapore as a natural choice. There is a global trend happening, and I think it's happening faster than we even realize, in that the traditional banking and financial services sectors are converging with the digital asset space. And a lot of it has to do with regulatory certainty, but I think that's how we can see that Singapore just becomes a naturally attractive place to do business. I think the last point I'll make is that the aligning to international standards like the FATF standards also is extremely important, I think, in legitimizing the regulatory regime that supports businesses, to put a foothold in one area and then go global from there.
Going into the application, right? So Form 1 is the primary application for licensed companies to apply for either a standard payment institution license or a major payment institution license, the primary licenses that fintechs go for. And I wanted to know if you have anything to add there about the application process itself. And then I thought I might open it up to Nick and Christoph or anybody else who has something to add about any unique challenges with the application process.
I think, so I'm not a lawyer, so I'll leave it to the esteemed panel to talk about the intricacies. But I think from my experience with the companies we've been working with is probably the naivety of the application process, right? It's here are the things you need to fill out, and therefore this is what we would do. We are constantly surprised at the documentation that we receive from our clients at how slim it is. And their view was this is good enough for the application, right? So we help them to basically make sure that they have everything in place. But I think the lawyers will have more in terms of some of the intricacies that we're seeing. But for me, it's the detail in the application has been, or the lack of detail in the application is something that we have noticed.
Christoph. Chris, if I may add here, I'd like to share some insights, practical insights, when I assisted one of my clients in the application process. To give you some practical insights, if I may emphasize that, the application process took about 1 year to prepare. That's the amount of time spent doing the homework. So it revolves around fine-tuning the business plan to make sure that they have proper internal procedures, policies, and controls for AML, CFT, and this has to be supplemented and complemented with a technology risk management audit by an external auditor to make sure that the user protection and the other incidental policies pursued by MAS is in place, and it's not just by way of a paper policy, but it is demonstrated in practice. So your preparation time is about 8 months to a year.
Thanks, Balan. I have to say, not all my clients did as much homework as that, but that is, sometimes that 8 months can get compressed in terms of late nights. Nick, you've worked on an application. What kind of thoughts do you have on this topic?
Yeah, I mean, I can echo some of Balan's thoughts there. I would 100% agree that the application is not just about what you put on paper. You need to be very careful, actually. You can over-promise on paper and under-deliver in practice, which is definitely not a good sign. So whatever you're putting on your application form, just make sure that you're actually doing that in practice. And when the MAS comes calling, with respect to your application process, you can show them what you've done in practice. So I would definitely echo that point. I would certainly say that you do need to do your homework in a sense that you need to know, as the whether you're the CEO or the compliance officer or the general counsel, whoever you are, and if you're in charge of filling the application form in, to understand your business, understand the operation flows, understand how that applies to the Payment Services Act. So you need to know your business well, but you also need to know how the Payment Services Act applies to you. And that will reflect in a, I mean, I would say our business plan was probably more detailed than most, but that's probably due to the fact that we aren't your typical DPT dealer or custodian or any other service provider that falls within the current or currently proposed Payment Services Act. So we set out quite carefully and in detail all of the operation flows and all of the services that we provide, whether they were ancillary or primary, and applied that to the Payment Services Act so that the MAS could follow step by step in a logical manner how our application was relevant to each specific section of the Payment Services Act and how our operations were relevant to that. So I guess in short, provide as much detail as you possibly can without over flooding things, but also by making sure that the MAS can navigate your business plan in the context of the Payment Services Act as easily as possible.
Thanks, Nick. Christoph, is there anything you wanted to weigh in on here?
Yeah, sure. So Balan mentioned that earlier. The AML CFT aspect is very important indeed. The PS Act requires that crypto asset service providers in Singapore should comply with those regulations, right? The PS Act is following the guidance from the Financial Action Task Force, FATF, to give Singapore a comprehensive regulatory framework in relation to crypto asset services. I think there are a couple of critical measures to ensure those businesses actually comply with the PS Act. The first one is a robust AML CFT solution. So typically crypto asset businesses in Singapore are tasked to file information about transactions they process to high-risk countries. And we all know who they are, right? Basically, they should be efficient in integrating a proper AML CFT technology system that will have a customer DD KYC platform for onboarding and screening, and B, a transaction monitoring solution. In fact, the Ospree solution in association with the Accuracy risk intelligence data in relation to PEP sanctions, adverse media, so AML KYC, can be very helpful in that regard. Number two, a proper financial crime risk management. So crypto asset businesses in Singapore must perform a risk assessment of what they do, where and what the money laundering risk could be. According to the PS Act, licensed crypto asset businesses should go through a quantitative and qualitative assessment of their core operations. So that's I think that's key. In conclusion, just for my part, in fighting financial crime, that's what we're talking about here. And having the right AML CFT measures in place should be a priority for crypto asset businesses in Singapore, but also anywhere else, starting from the senior management, which probably should be heavily involved in defining the strategies in relation to that. Both FATF and NAS have confirmed that. The cultural aspect is also very important to ensure that anyone in the firm is fully aware of the money laundering risk and regulations. So therefore, a training program is key. Another recommendation would be to assign a money laundering reporting officer or someone acting in that role. I think that's also very important.
Now, going back to financial crime, I think this is a good point to turn to Julian. I mean, Singapore is seen as a very fintech-friendly jurisdiction and crypto-friendly jurisdiction in a lot of ways. But cryptocurrency is still considered to be higher risk for a lot of criminal activity, especially money laundering. Why do you think this perception exists? What should fintech companies do in response to this perception?
Yeah, I mean, I think the simple answer is because they do pose inherently more risk than kind of fiat analog, right? And as Christoph was pointing to, there has to be a very disciplined and concerted effort to address AML and CFT risks in a very systematic way, right? So, for example, even before you start thinking about AML, specific, controls, you want to think about what digital assets do you support and why do you support those digital assets? What customer types do you support and why do you support them? And then you dive into some of the inherent challenges in managing AML CFT risks, and you think about building specific programs that address those issues. You also, we give this advice to anybody that's working in a novel space, but even more importantly in digital assets. You want to be forthright with your regulator in describing to them the risks that your business poses in a lot of detail, and in sharing with them why you believe that the way that you're managing those risks is appropriate and meets the standards that they expect, and sometimes standards that are not actually written down. And so, this is a discussion for another topic, but the travel rule is a perfect example of that, right? Where there is not an industry-wide standard yet on how to comply with the reporting requirements for the travel rule. And so that just creates very, very inherent challenges. I would say on the other hand, digital assets actually do provide tools for greater transparency depending on the blockchain protocol. You can actually look at the provenance of transactions to a certain extent, and there's some great sophisticated services and tools out there which help you, look back at the provenance and determine kind of whether these assets have been tainted or not. I guess finally what I'll say is that, there's more regulatory scrutiny on AML for digital assets, and the industry is working on common standards for compliance, and I think that's a very good thing. To give you one illustration of how complex this issue is, we recently wrote guidance for a global regulator. We wrote supervisory guidance for them across all different disciplines that bank supervisors would look at, and the AML guidance was about 30% of all of the guidance that we wrote across all of the different risk and compliance disciplines. It just tells you how important this area is.
Nick, you're an old world lawyer like me. How successfully have you integrated, software and technology in your management of compliance?
Yeah, it's a great question, and I think the importance of integrating compliance technology into your compliance function cannot be understated. We have had to do that because we want to replicate what an investor would expect in an asset manager in the traditional markets, and with the types of service providers that want to support you, they may not necessarily experience in this sector as well. And when we're talking about in-kind subscriptions or in-kind payments or deposits, there needs to be comfort around accepting that type of transfer. And with the vast amount of raw data which you're dealing with, given that, as mentioned previously, all the transactions are on the blockchain, it can be somewhat overbearing. We have used a number of service providers, and actually we've been using Osprey, and they've been helping us to create bite-sized and easily digestible reports on in-kind deposits. We've been using compliance screening tools that allow us to create bite-sized and digestible, screening reports that not only allow us to use the information and target that specifically to our compliance function, but also provide comfort to those service providers that we use in the same aspect of our business. So it's certainly crucial. If you find the right service provider that can help you navigate your way through, and your service providers through this aspect of your business, then you're on the right track.
Well, Javier, you certainly have a happy client in Nick there in terms of the software you guys offer. Talk about the practical problems that crypto companies face. What are the KYC and KYC tools that they need, and what are the incentives that they have to use these tools in their business?
Yeah, right. So we talked to many companies over the last few months. One of the things we found was that companies not only struggle in the preparation of the documents that they need to submit for the application, but also when they have to design and implement the processes and controls that involve compliance solutions, they find it very complex and very difficult. And I give you an example. So for some reason, new companies, one of the first things they do when they think compliant is they purchase the license of a KYC solution for 1 year. Later on, they realize that many of their customers, they will be onboarded online, right? So they need to also buy the license of identity verification software, right? Later on, they also realize that they need to buy a transaction monitoring solution that help them identify red flag and suspicious activities of incoming and outgoing transactions in cryptocurrencies. So the problem is that if you buy all these free solutions thinking that they operate in isolation, at the end of the day you will spend much more time and resources, right? And also if you want, there is a new requirement in a number of jurisdictions, and Singapore is one case, that bus companies, they need to comply with a new requirement called the travel rule, which is it makes even more relevant that KYC solution, transaction monitoring solutions, and also identity verification software, they are synchronized and they operate on an ongoing basis, right? So yeah, this is one of the most common challenges that we have found. And regarding your question about the incentive of cryptocurrencies in adopting these tools, to me it's very clear that one of the main reasons that why cryptocurrencies are perceived as posing higher risks is because they are connected to anonymity, right? And all these compliance solutions, essentially what they are helping to do is building these connections between your on-chain processes and your off-chain processes, right? So connecting the identity of your customer accounts with the transactions that happen in the blockchain, right? And many of the regulations are aiming in this direction. So removing the capability of anonymous individuals operate in the cryptocurrency space.
Now, I hope that we've inspired everyone to love compliance and regulation. That's my dream for this panel. But it's possible that we haven't. And so I'm probably going to open this up to everyone, starting with Balan. What are the implications of a virtual asset service provider if they do not meet regulatory obligations? They say, yeah, this is all cost, I'm going to lose customers, I don't want to do it. What is the downside if they do not comply with regulations?
Well, I usually tell this to my clients. Compliance cost is high. Try non-compliance. it's going to be higher, because you are going to attract civil and criminal liability. And that is something that all serious crypto companies should strive to avoid.
Great point. I'm going to open this to everyone. Christoph, do you have anything you want to add here?
Yeah, simply it's not about liking compliance and risk. It's really about, you know, just complying with the regulations in place. I mean, I think that the risks are too high, and if you know, you've got the right solutions, and again, there are plenty of good solutions in the market, I guess you'll be fine.
Javier?
Yeah, so my comment here is that for those of us that have been in the interacting with the crypto space or digital asset companies, we know that without compliance or without paying attention to compliance, it's really difficult to scale up a business. So it's not realistic that a company can really succeed right now. Maybe like 5 years ago, there was not too many regulations in place, but right now, the question is, there is no option, right? So, but also there is a practical reason. So, if companies in this space, they need to have interaction, for example, with banks. So it's relevant they have like a common language. So they have a space, a zone where they can interact. So it's not only the cost of compliance, but also it's creating the building the common language. So these two areas can interact, right? So we know that banks are heavily regulated. So it's really hard to think that a bank will interact with a fintech that is not regulated at all, right? So there are so many frictions that will happen, and that kind of what we have seen is that in a way that stopped the industry to grow faster, right? So we can see also compliance as a way of consolidating this industry, and from there, much better things are going to happen.
Thanks, Javier. To add on to that point very briefly, we've been helping unregulated businesses that aren't even applying for a license, with KYC being done by banks or financial services companies, because they have to do KYC on all their service providers. So compliance, even if you think you may not need a license, you need to get your head around compliance, because your customers may require it and your investors may require it as part of a sound business model. Aga, what would you add on this?
Compliance is mandatory. You know, as like Bahan said, it's not an option. If you want to do business here, you need to become compliant. I also support Christoph's view. There are some really good service providers here to help. It is still fragmented, and you know, there are groups working together to bridge that gap for small, medium enterprises, to make it easier for them to navigate through the Payment Services Act, integration of third-party suppliers, and now the new travel rule, right? So I think you'll see shortly, you know, middleware or aggregators of all these services that companies can use that will make their life a little bit more easier and not so expensive and quicker, because we are learning through this whole process. So I'm very bullish about where the industry as a whole is going around technology to support the great companies that want to come here. So yeah, I'm looking forward to it.
Nick, I know you love compliance, but if you didn't, what would be the reason that drove you to comply anyway?
You know, it's interesting. I've been working in this industry, moved from, as you mentioned, you know, being a traditional lawyer in a private practice law firm. And when I started in this industry, you saw a lot of, you know, what we call regulatory arbitrage from companies in this space. You know, looking for the jurisdiction that allowed you to be licensed with the fewest amount of requirements to get that license possible. And you know, those avenues are drying up, and I kind of would invite the audience to look at compliance in a different way. Don't look at it as a mandatory function. Think about what the purpose of compliance is. It's about providing your clients, your customers, with the protections that they require. And think about, what would your clients, and as you said, Chris, what your investors, what your users actually want to see from a service provider, from an asset manager, from an exchange, whatever you are. If you choose not to comply, you are in effect servicing quite a small niche section of the market that doesn't necessarily want to see these protections in place. Aside from the cost of actually having to pay any fines which come your way, or having to pay for compliance solutions to be put in place later, there's actually also an opportunity cost to not obtaining the market share or the client base that you would have otherwise been able to obtain had you been compliant. And that's certainly something that we are experiencing firsthand. We have seen the demand for our product increase drastically as we've seen more regulatory and clarity within Singapore and clarity around the regulations in this space.
Thanks, Nick. Julian, what can you add here?
Sure. So, let's think about it this way. Put yourself in the chair of a fintech founder. One of the things that you're thinking about, ultimately, is what your exit strategy is. In addition to scaling your business and building your business, et cetera, you always have an eye for, who could I be acquired by? How could I potentially, add value? How could I bring back value to my investor base? And so, before Promontory, I worked at Visa and I led our risk due diligence for all of our acquisitions. And I can tell you, I can't tell you the number of deals that we passed on because we did not have faith in their compliance programs. We did not have faith in their risk management programs. It was just too expensive. No matter how compelling or interesting the business might be, what we called the Visa tax, which was what we needed to invest in that firm to bring it up to the level that we felt comfortable, it just didn't make sense. And so this is just foundational, especially if you're in financial services. That's really not negotiable. And think about it as an investment in the future and in the potential for your business as a whole.
I agree with that. And I think that also goes to where you want to base your operations. I know there's some businesses that may say, oh, I'm just going to operate in a very small jurisdiction with no rules, and I'm compliant in that jurisdiction. And so everyone should be fine dealing with me. That's actually not how it's going to work in the long term. The major institutions and investors will just not work with you if you're working in one of these haven jurisdictions that they don't have robust compliance requirements. So while there might be a few of those countries left and you might be able to get away with it for a while, that time is ending soon. So you better have a business model that can be compliant and that you'll be able to deal with the best customers. Otherwise, really, what business do you have? Now, all that said, I thought we had a great panel. I was really happy, but it's possible I've missed something. Does anyone else have anything they'd like to add? Wave your hand. Otherwise, I'm going to declare victory. I think our audience now knows everything there is to know about navigating the Singapore regulatory framework. But I hope you believe we're all pretty friendly, and so feel free to reach out to any of us individually. LinkedIn, Google, it all works. Thanks, everybody. Thanks to IBM and Osprey.
The travel rule is a rule that's existed in traditional financial services since, I think, the 80s, something like that. And basically what it means, it's not like actually many people thought in the beginning, including myself, about like when you fly somewhere and they ask you if you have $10,000 or more. What it actually is about is anytime that there's a financial transaction going on, historically it's been over about 3,000 USD. Your identity information needs to travel along with the transaction between the financial services providers. They do that for a couple of reasons. The first reason is to allow for sanctions screening so that your customer's counterparty isn't a member of a terrorist organization or someone else that they shouldn't be transacting with, but also for record keeping purposes. So if in the future law enforcement has the needs to know who was on the other side of the transaction, they can go to the regulated entity in their jurisdiction and get a feel for who their customer was transacting with. Look, I think the biggest difference between Transact ID and the other solutions that are on the market is really, honestly, comes down to a really core and fundamental approach. If you look at the traditional financial system, all transactions that happened online, on a network, happened between regulated entities. They happened between banks, between money service businesses, et cetera. There was never like a peer involved in one of those transactions. And so the systems that were used for things like travel rule all operated under the assumption that both ends of the transaction were going to be a regulated entity. And the trust model around the identity was all based around that. All of the other travel rule solutions on the market basically copied that model. And so what that means is they work very well in a VASP to VASP model. But when you run into the, frankly, much more complex environment of cryptocurrency, you start to see that they can't cover all of the transactions. They can cover those VASP to VASP transactions, but they can't cover other regulated transactions such as VASP to unhosted wallets or VASP to peer transactions. And so really, I think that the biggest difference between the solutions on the market is really, whether or not you need to already trust who's on the other end of the transaction before you start it, like you do in the traditional financial world, or whether you can establish that trust during the transaction so that you can allow transactions between any two counterparties on the network, as long as those counterparties are comfortable at the time of the transaction. My hope is that by the end of 2021, most protocols will be able to converse relatively cleanly with each other. I can tell you on our roadmap, with all of the protocols that have agreed to integrate with us so far, we believe that we'll have full general availability, interoperability with them by Q2 of next year. That would have all 4 of them complete by that time. I know others are on different timelines that could be a little extended out from there. We're basically we're a little ahead in terms of release status from many of the other platforms. We started development a little earlier than others. And so as a result, we're actually planning our interoperability for different products, just as those products get into their general release. And so as they get into a fully live production environment, we should be interoperating with them. I suspect that they won't have global interoperability at those periods of time. And so there may be some places where some of the other interoperability that they're putting in place may fall behind some of those pieces. But I do think that by the end of 2021, hopefully most of the major pieces should be communicating with each other. Right now, there's only a couple of stragglers that are not really sure of how they're going to do interop yet. So different solutions have different models around how that billing works. Some have per transaction fees, which we think that over time is going to create a lot of friction on the ecosystem. Our belief is that over time, more and more transactions are going to shift to crypto. So each user is going to have more and more transactions every day, week, or month than they did the month or year before. And so from that perspective, we actually went with a pricing model that is pricing per user rather than per transaction. And so in our case, the pricing is going to typically be on the order of, dimes a user a year, maybe a little more than that at lower volumes. We provide tools that allow companies to be compliant with the requirements around, say, travel rule or customer counterparty requirements around sanctions screening. We provide the data layer to exchange that, but we don't provide some of the enriched data that needs to get pushed around that, like the on-chain monitoring and data analytics that's needed in order to help make the decision. We don't provide the business logic that actually helps to drive that towards an actionable decision for people. And so by, as you talked about, by bringing these multiple components together, you can help your customer to drive towards a great and easy decision across a robust set of diverse data sources, where the travel rule tools that we build definitely let people meet their travel rule requirements. But there's other things that you're going to want to do around the transaction that Osprey can help you with that are another part of your risk-based approach, another part of your monitoring, another part of your decision-making that allows you to do that much better than you could with just a protocol.
Hello, everyone, and welcome to Coffee Talk with Osprey and IBM. Today, we're talking about security recommendations for financial institutions. And I have with me, myself, I'm Anne, I'm from Osprey, and this is Javier, also from Osprey. And we have Peter DeMio from IBM. Hello.
Hello.
So, Javier, why don't you give us what is Osprey?
Sure. My name is Javier Tamashiri. I'm the co-founder of Osprey. And essentially what we do is helping financial institutions that they are getting into the cryptocurrency and digital asset space to comply with anti-money laundering regulations. Our solution has multiple modules. So companies, depending on the stage where they are or the type of business they are running, they can use different features. So we are also covering different jurisdictions, APAC, Europe, and also we are launching some activities in North America.
All right, and Peter.
Hi, everybody. Peter DeMeo from IBM, and I'm responsible for confidential computing with digital assets globally. And I work and support a team of international people, both from that are engineers, researchers, cryptographers, consultants, sellers, marketing, and so forth, all working together in IBM systems to provide environments in which digital asset application providers and analytics providers and the like are able to focus on their core business and less on the security and the privacy and confidentiality of the data in which they're working upon.
And Javier, what kind of financial institutions are we going to be talking about today?
The crypto space and the digital asset space is evolving very quickly. Companies in the traditional financial space, they are incorporating these new assets. So for example, we have payment companies, we have banks that they are taking the role of making custodians of digital asset and cryptocurrencies. There are also payment companies that they are enabling payments in crypto.
Yeah, there's a full spectrum of different financial institutions that are out there, whether you're talking about hedge funds or family offices, high net worth individuals for that matter, and of obviously, banks and various kinds of banks. When in the U.S. we have special purpose depository institutions, which are allowed exchanges, in fact, like Kraken can become a bank, if you will. We also have like Avanti that are, all digital platform banks, right? And of course you have, the small and medium-sized banks, and then you have the mega banks, the big four institutions, and those are custodians. Well, the entire, I think, spectrum of all of these institutions, have a common problem, and that's around compliance. And some take it a little bit more seriously than others, but nevertheless, as you move towards a more regulated environment where you're closer to FinCEN, you do tend to pay attention to these things in a more substantial manner. And I do think also, the banks, quite frankly, have been traditionally regulated the most, and they have the highest threshold, I would say, for compliance. And so, the banks ultimately, as they are becoming enabled to deal with digital assets, if you're a bank and you're regulated, and now you have a potential for new top-line growth with digital assets, okay, and I'm a risk and compliance officer, I'm used to basically, doing KYC, in a traditional way, and all of a sudden you're throwing this blockchain stuff at me. I'm like, what am I supposed to do with that? And of course, all of that will have an impact, potentially an adverse impact on the bottom line and the ability for these banks to actually take advantage of these new business models, right? So there needs to be a way for, the more old school regulatory and compliance officers to able to adopt to blockchain and on-chain kinds of transactions, and not, if you will, slow things down with so much friction that it becomes, highly costly, or therefore you have to hire a lot more people in order to do it.
That's such a perfect explanation of what we perceive the pain points to be right now. So what basic compliance requirements must financial institutions accepting crypto follow?
Financial institutions, they need to have a couple of processes in place. One is know your customer, which is it's called KYC, which essentially is about collecting information of customer at the moment of the onboarding. Then if they get into the cryptocurrency and digital asset space, they also need to have a transaction monitoring system that enables them to detect suspicious activity. And also another requirements that they will need to have is something called the travel rule, which essentially is it's a protocol that enables companies to exchange the identity information with the transactions that they send and receive from other institutions.
Okay, Peter, do you have anything you want to add?
Well, I think it's at the end of the day, what we're trying to do is raise the confidence level of the compliance officer. Are they able to process all of this additional data and make something out of it in a way that they can come to a decision and defend that decision in a much faster and more effective manner? And I think that's kind of, at the end of the day, what solutions like Osprey can really bring to the table for a compliance officer.
Thank you for that. So what kind of questions should financial institutions be asking when they are shopping for an AML compliance solution?
Of course, there are many ways that you can think of a solution provider. From a technical perspective, maybe you want to look into the scalability of the solution, security, adaptability, support. Also, you want to look into if you are planning to expand to another jurisdiction because your business is growing fast. So then you need to ask your question, is this solution going to cover me in this new business zone? A more in detail question that probably you need to think is how this solution is going to help your compliance officer to make a much better job. So there are a lot of complexities and probably costs associated when it comes to choosing which one is the solution you want to use. So just to give you an example, companies, especially banks, they struggle with the solutions that generate many false positives. So if with your existing compliance process, you add a new type of asset like cryptocurrencies or digital asset, together with those new type of assets, there are a new way of applying controls, right? So it's very relevant that the solution that you choose, it gives you the capability of making apply automation and also run your compliance process on the exception, right? So you cannot analyze every single alert that your system will generate. So you need to have a smart system that only create alerts when it's relevant. And when the compliance team decide to make an investigation and eventually escalate it, you have all the resources and tools to drill down into the data, and when it's necessary to create a report and at the ultimate stage to submit it to the authorities. You need to think carefully how that solution is going to integrate to your existing compliance process, right?
Again, it's about reducing friction. How quickly can you get to the right decision, and how do you know it's the right decision? And can you trust what you're looking at? And how do you know you can trust what you're looking at?
Could you explain how transaction monitoring works and helps in mitigating this risk?
One positive thing of blockchain is that the information is public, and the information is stored in a public ledger, right? So there's tons of data that could be analyzed and can be used to create risk scores following a risk-based approach, and can give you an idea of how risky that address or transaction is based on the history of that hash. What it's really important to mention as well is that when it comes to traditional financial institutions, all the data they have from their customers. Your customer, when they create the accounts, they need to pass the KYC. They have a risk score for associated to the account. When you analyze the information coming from the blockchain and you assign risk to a specific blockchain transactions, it's fundamental that you analyze any red flags that you identify in the context of the account that is associated with that transaction. And that's where we can help. So we are putting together the information of your traditional compliance with the on-chain processes in the blockchain. So we give you a risk score for every on-chain transaction, and we can help you to put together with your traditional compliance and make sense of those two words together in one single view. What happens when you use that? Well, you have much better data and you will have much better alerts, probably that can help you to reduce false positives. That will impact in the number of compliance officers that will need to spend time reviewing those alerts. So there is a cost association. When you increase the efficiency and the smartness of your monitoring solutions, that will be reflecting your cost, right? And also you have to think that if there is an incoming transactions that they are red flag, probably you are stopping the transaction for a few hours, right? So you don't want to create a lot of friction and review unnecessary transactions, right? So you want to spend the minimum amount of time making sure that you are compliant and your entity is not associated with any illegal activity,
Yeah.
right?
I think it's also worth mentioning that the maturity of regulations plays a part here too.
I would agree on that point. I think, we think about the work that IBM is doing with the state of Wyoming for the speedy licenses. There's definitely a dearth of let's say model bank supervisory guidance and examination procedures out there as it relates to digital assets, and that I think is a contributing factor to the ability for a compliance officer to really have all the information and, let's say, the steps and things to look at in hand, even basic checklists, for example, like, do they have procedures to do wallet integrity audits, or, key or seed generation procedures, or, do they have procedures around completed transactions, ensuring that the compliance, the proof of evidence is there, suspicious transaction handling. Think of it like model supervisory guidance. In a particular jurisdiction is absolutely critical for a compliance officer to be effective in this role.
What is very important to understand is that especially in a bank where you have your three lines of defense, and when you are incorporating a very complex asset like cryptocurrency or digital assets, it's very important that your business, your compliance team, and your audit functions, they understand what are the risks involved and how they need to handle any potential risk associated, right? So there is a lot of discussion that involve the different areas of the bank, how much work you need to apply, and also there is a component of training, right? So let's say that you have your compliance team, and the first day that compliance officer is interacting with alerts that involve crypto or digital asset. Well, so the question is how they can assess that information, right? It's not just about providing the tools, but also empower the team to make right decisions. So there is a lot of training and also, of course, governance involved. So what we have done with companies like asset management firms, so we have conversations with the audit function. Also, lawyers, they ask questions about how to incorporate this new asset into our anti-money laundering program. There are a lot of challenges there, right? You have policies, you have controls, you have processes, and now you have a new product that in nature is perceived as high risk. Well, so there is a lot of work to be done there.
Thanks for that. So on that note, I think we'll wrap it up. What is the next step to get in touch with us?
Well, they can visit our website, so osprey.io, or reach us through our LinkedIn or Twitter. So we are very fast at responding. And also, I think we will add into the description of this video our contact information.
All right. And same to you, Peter. How can someone get in touch with you?
Anyone from IBM with respect to our hypertech platform can take a call. So, but you can always call me, and the email will be provided, pdemayo@sg.ibm.com. And so we're more than happy to tell you more about the kinds of things we can do.
Excellent. All right. Thanks for joining us, everyone, and have a great day. Bye.
Thank
Bye-bye.
you. Bye-bye.